Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about some of those unexpected expenses or unexpected events that we see in retirement that you just don't really plan on. It seems to be each time that we get together with somebody who incurs some of these unexpected events or some of these expenses, they really could have planned a little bit differently and avoided them completely. Some of the items we're going to talk about here hit your income 100%. And then there are some of the things we're going to talk about. They're more of events that you just have to plan around. So really, one of the number one unexpected expense in retirement is taxes. We see that a lot. Somebody will go into retirement. They think that they know where they should withdraw from which accounts that are going to be the most efficient for their income. But many times they forget about the taxes. And there are also certain type of investments that you look at that are more tax efficient than others. Obviously, if you look at tax deferred, such as IRA accounts, that is going to be wonderful for accumulation. But once you start to withdraw from those accounts in retirement, you have to plan on the taxes that are going to be assigned to those withdrawals. So you have to understand that. Then there are also certain investments where you pay taxes as you go along, such as some non-qualified investments. You're going to be paying those capital gains. And if you don't plan around those capital gains, those can hit you at a time that you're not expecting it. So, Tyler, as far as taxes, let's talk about some of the taxes that people incur once they retire and some of the unexpected taxes they're not planning for.
Yeah, Dean, so obviously this is a big one. And there's so many people that we see where once they retire, they don't realize the impact that taxes can have on their overall financial plan, their investment accounts, their income situation. So we're going to cover a number of those scenarios today, with the first one being taxes on IRA withdrawals. So this is one that can catch some people by surprise, where once you retire, you're no longer getting paid through salary or payroll, and you might have your Social Security benefits, maybe a pension, and then the other income is from your retirement accounts. Well, right now, many people, the main form of retirement account that they have would be through a 401k or a certain type of pre-tax retirement account that was then maybe rolled over to an IRA, which stands for individual retirement account. Now, once you take money from your IRA, any withdrawal that you take is considered ordinary income where you're taxed on the full amount. So if you have an IRA worth, just for example, $300,000, and you take $15,000 from that account in 1 year, then that full $15,000 that you take out will have to be recorded on your tax return, because it's 100% fully taxable once you start taking the money out. Now, like you said, Dean, every year that you're accumulating this money through your payroll, through your 401k, you never pay taxes on it. So this is one where the IRS, they get you on the back end, since you never paid taxes on it when the money went in, you're taxed 100% when the money goes out. So again, this is an unexpected expense that many people don't realize, and they don't account for it. But if you have an IRA, you want to make sure you plan for taxes, where if you're taking money out, you need to know, okay, everything that I take out in this year is going to have to be recorded on my tax return. And there's also one other situation that we see a lot, where if there's people that they might have a one-time expense where they want to get a new vehicle, or if they need a new roof, or something goes out around the house, an appliance, whatever the case might be, and they think they can take a one-time lump sum withdrawal from their IRA, oftentimes they forget about the tax impact of taking, or the tax implication of taking a one-time withdrawal. If you take a withdrawal of $30,000, $40,000, $50,000, that very well likely could bump you into the next tax bracket. And come tax time, you're going to owe quite a bit to the point that it's going to feel a little bit uncomfortable. So you always want to account for that.
Okay, in addition to that, Tyler, you bring up a good point about bumping you into a new tax bracket, but also it can basically penalize you as far as taxes incurred on your Social Security benefit. And again, we see that one a lot where people will have, let's say they'll have taxes withheld from their Social Security benefit, which is only at the federal level, not at the state level. And then they'll take and withhold taxes from their IRA distributions in retirement, very common. But what happens is, let's say they take a larger distribution from an IRA, $20,000, $30,000, $40,000, $50,000 for whatever they need. Maybe they're remodeling or purchasing something. And even though they withhold what they assume would be the taxes on that IRA, they are recording additional income. So what that's going to do is bump up the taxes incurred on your Social Security. So for instance, there are 3 levels of taxes on Social Security. There's 0% that you have to pay on taxes based on lower income. And then there's a possibility that 50% of your benefit could be taxed, and there's a possibility of 85% of your benefit being taxed. And again, that's all based on income. So if you take a lump sum from an IRA, many times it makes 50% of your Social Security benefit go up to that 85% of your benefit becoming taxable. The other thing too is, again, Tyler was talking about IRAs and withdrawals. Many times there are ways to go into these tax situations in retirement, make them much more appealing, and that is by converting a number of your accounts at the right stage of your life. So for instance, we are advocates. We try to pound this, into our client's head, and that is in your 50s, try to convert do Roth conversions in your 50s. You're best served to be able to do it at that particular time. It's going to help you later on. Right now, through the tax reform, basically taxes are on sale. A lot of people are very happy with what's happening with tax reform laws. But remember, that doesn't go into perpetuity. That's not forever. That will be voted on again sometime in our life, and maybe not in the near future, but a little bit further down the line. But taxes will always change. So if you're looking at one of the best ways to help you in that situation in retirement is look at converting some of your IRAs to Roth in your 50s.
Yeah, Dean, good point there. That's one of the number one ways to get around that and lessen your tax burden is by doing Roth conversions. That way you have Roth accounts that you can withdraw from. And again, Roth accounts you don't have to pay any taxes on. One other thing with your Social Security benefits being taxable, if your modified adjusted gross income is over $34,000 if you're single or $44,000 if you're married, then up to 85% of your Social Security benefits can be taxable. So again, in retirement, it's important to have a plan. And if you can have a plan where you can determine what your income is, then there's ways to get around that where you don't have your Social Security become taxable. But again, many people don't realize it that yes, portion 50% or up to 85% of your Social Security benefits can be taxable. In addition to that, pension or taxes on pensions as well. Many people, they'll come into retirement and have pensions and they don't realize it, but once you start taking that pension, that is also fully taxable too. So you want to make sure you account for that, have taxes withheld there if need be. And then lastly, when it comes to taxes, there's also taxes on non-qualified investment sales. So that's also considered capital gains. And this is one that we see a lot where a client might have a certain portfolio that they started considered a non-qualified account where they have money that's either in checking or savings or an inheritance that they put into an investment, and anything that they put in, they don't pay any taxes on. However, any of the gain portion, once they take a withdrawal from that, it is taxable at that point. So one thing that happens is they're not accounting for the taxes. And the other thing, if you are to simply make an investment move, or if you sell off a certain fund within a non-qualified investment, that can generate a capital gain and hurt you tax-wise. So we always use the term we like to hunt and peck when someone has a non-qualified investment account, where we've got to always watch out for the tax implication if we were to make a move within that account, because it can affect you big time tax-wise if you're not aware of that. So taxes, that's one of the main unexpected expenses in retirement. Everything from your IRA withdrawals to your Social Security benefits being taxed, to your pension being taxed, to taxes on the sale of non-qualified investments. So taxes is number one. One of the things that you can do to get around that is have a financial plan where you can control your income and you know how much you're going to have to take, so that way you can minimize taxes on your Social Security benefits. And then also, like you said, Dean, try and convert those IRAs to Roth accounts early on. That way in retirement, you don't have to worry about taking money from an IRA that's fully taxable. You want to have a little bit of tax diversification, as I like to call it.
That's right. Okay, Tyler, the next one we see quite a bit is inflation. People don't expect inflation, or they're aware of inflation, but they just don't want to admit the fact that they have to account for it in their retirement. And many times we'll see this with somebody who really wants to retire bad, and they might not have enough funds that they should really have in place for the retirement. So what happens in a situation like that, unfortunately, is they will put together a financial plan, and they will assume that their fixed income is going to carry them far enough into their retirement, and they don't have to worry about inflation. It doesn't work that way. Inflation is actually a risk that you take on in retirement. And one of the big mistakes we see with not accounting for inflation is also setting up investments too conservatively. Now, we believe in the three-bucket approach: safety, income, and growth. And it's important to have all of your investments at least work in one of those buckets. We would like to see all three of them represented in your retirement plan. But sometimes we will see people, as they get closer to retirement, they go one of two ways, which is actually a mistake, and that is they become way too conservative, thinking they have enough money, so they just don't want to compromise losing any of it. And then what they do is put them into investments, and some of them could be long-term or short-term, and they really don't grow enough, and inflation erodes away at those gains. And then the other mistake we see when people go into retirement is if they don't have enough funds to really retire comfortably, they become too aggressive. Basically, they're trying to catch lightning in a bottle. They want to catch every gain you can possibly catch out there. Unfortunately, they're going to catch most of the risk too. So what we see are those two things. But from an inflation standpoint, it starts with your investments. You need to look at your investments. Make sure you have those three buckets taken care of. Safety will be some of your fixed income. Safety will be cash. Safety will be some annuities, like a fixed annuity, maybe treasuries. Income will be income production through bonds. It could be income through annuities. It could be risk-managed investment portfolios, preferred stock, or dividend-producing stock. And then growth. We want to have some growth there. You can do that with blue chip stocks. You can do it with mutual funds and ETFs that have some growth opportunities, which means they're predominantly 80% or more equity versus bond positions. So we want those things in place. Why? Because we have to account for inflation too.
Yeah, when it comes to inflation, one of the biggest mistakes that we see, as you mentioned, Dean, where people actually get too conservative with their investments to the point that it doesn't keep up with inflation. So again, you want to have the three buckets: your safety, income, and growth. And to counter inflation, it's very important to have that growth bucket there. And again, that's where you're going to be able to go in certain investments that are going to outpace inflation over time. But again, inflation is one expense that many people don't account for. And we see it all the time, where you might have a financial plan where your income is $2,000 a month, but yet your expenses are $1,900 a month. That's not going to last over the long term unless you account for inflation and increase your income over time to cover your expenses. So you always want to assume that your expenses are going to increase over time. And I've got a few statistics here to kind of point that out, where if you go back to 1990, the average price for a gallon of gas was $1.25 per gallon. Now, this is going back a couple years, but in 2015, it's $2.52 per gallon. 1990, the price of Girl Scout cookies were $2 a box. Well, now they're over $5 a box. And lastly, in 1990, the price of milk was about $1.70 per gallon. In 2015, it was up to $3.75 per gallon. So again, as we all know, over time, the cost of goods and services is going to go up. The cost that you spend on different things in retirement will go up as well over time. So you want to make sure you're accounting for inflation. One other thing is, many people, they might target a withdrawal rate of 5%, for example. So let's say someone has a $500,000 portfolio. That's the total of all their investments added up, $500,000. If they take 5% of that, that would be $25,000. Now, what's going to happen is over time, if they continue to take 5% of that, their expenses are going to go up and they won't be able to live off that. They're going to have to start taking more. So one thing you might want to consider is, again, $500,000 times 5% is $25,000. But then you want to increase that $25,000 that you're taking by 2% each year to account for inflation. So then in year 2, instead of taking $25,000, you might take $25,500. So again, inflation, you always want to account for it when it comes to your retirement and your financial plan. One way to combat inflation is to make sure, as you said, Dean, that you have your safety bucket, your income bucket, and your growth bucket. And to counter inflation and outpace inflation, that would be the growth bucket, where over time, that growth bucket, you'll outpace inflation based on different stock funds, growth mutual funds, growth exchange traded funds. So make sure that you have all your bases covered with your safety, income, and growth.
Okay, before we go on to the next unexpected expense, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, the next expense we're going to talk about is required minimum distributions. A lot of people hear of these RMDs, but quite honestly, they think they're so far off in their retirement that they don't think about planning around them. A required minimum distribution in its simplest form is nothing more than having to take a distribution from your qualified accounts in the year you turn 70 and a half years old. What happens? You withdraw money, taxes is applied, and taxes go into the system. You take the money and you can do one of a number of things with that money. You can spend it, you can give it away, you can reinvest it. Tyler and I typically recommend it's one of the first two: spend it, give it away versus reinvesting, because one thing you really don't have on your side on that at that particular time is time. So, learn to spend some of that money. However, if you don't plan around your required minimum distributions, you can be forced to have to take a withdrawal that you're not planning on. So what does that do to the rest of your income? Quite honestly, it makes it much more taxable, because you might be in a new tax bracket. It could push your Social Security into a new tax bracket. So again, planning is important. However, I'll go back again to what I said earlier, and Tyler and I discussed, and that is by converting some of these qualified accounts in your 50s, you don't have to worry about your required minimum distribution then, because it's only put on those traditional IRAs and 401ks, not on Roth accounts, not on non-qualified accounts, and not on cash. Tyler, what else as far as RMDs that our listeners should be aware of?
Yeah, Dean, when it comes to required minimum distributions, again, like you said, that's the amount that you have to take. And many people in general aren't even aware of what your required minimum distribution is. But again, it's a distribution that the IRS says you have to take from your pre-tax retirement accounts, like your IRA, your 401k, your 403b, 457, profit sharing plan, whatever the case might be. It's money that you have to take from those accounts by the year that you turn 70 and a half years old. Now, it's very important that you do take them, because it's one of the stiffest IRS penalties that there is, where the penalty is 50% of the amount you should have taken. So let's say, for example, if your RMD amount was $10,000 in a given year and you don't take it, well, then you still have to take it, but the IRS gets $5,000 of the $10,000, and no one wants that. So RMDs, something that you have to account for. Now, one other thing, like you said as well, Dean, is that there are no RMDs on Roth accounts, which are very beneficial, non-qualified accounts, and cash positions. So again, that's another reason for converting to a Roth early on before you hit retirement. And in addition to that, when you're younger, try and save in Roth accounts in general as well. Open up a Roth IRA and try and save there too, because again, that's something that you won't have to take RMDs from. And just to kind of illustrate the concept of required minimum distributions, the first year RMD amount is about 3.65% of the account value. So again, going back to our example earlier where we used a $500,000 portfolio, on a $500,000 IRA, the RMD would be $18,248, and that percentage increases each and every year. So again, if you have a $500,000 IRA account and you're turning 70 and a half this year, then over $18,000 is what you have to take out whether you want to or not. And again, if you don't take it out, then you get a $9,000 penalty. And as you said, Dean, with that, typically there's one of three things: spend it, gift it, or reinvest it. We like to see people spend it or gift it, because if you reinvest it, you're taking money out of an account that you're taxed on when you take the money out. Then you can only reinvest it in another account that's going to be taxed on, so you're double taxed on it. Now it is an option, but again, we like to see people gift it or spend it. But RMDs, be aware, because at 70 and a half years old, you're going to have to start taking them whether you like it or not.
Okay. The next expense, and this one catches a lot of people off guard, and that is your Medicare Part B expense. Understand the basic process here. First of all, Tyler and I don't work for Medicare. However, we have to know how the Medicare process works because it's a very important part of the retirement process. So you put Medicare Part A in place when you turn 65, actually 3 months prior, 3 months after, or the month you turn 65. So you put that in place, and even if you're working, that Medicare Part B doesn't have to be put in place. But once you decide to retire after 65 years old, your Medicare Part B needs to be put into place. So Medicare Part B gets put into place. That is a charge to it. So for instance, in 2019, your Medicare Part B charge is $135.50 that the government charges you, okay? It is not the Medicare Supplement agent or the Medicare Advantage agent. It is the government. And if you're drawing Social Security prior to applying for Medicare Part B, you probably are relying on that particular budget that you set up. All of a sudden you start looking at your Social Security benefit and what you're supposed to receive, and it's reduced by $135.50. That's correct. That is your Medicare Part B automatically coming out of your Social Security benefit. If you're not drawing Social Security when you sign up for Medicare Part B, they will bill you quarterly, okay? They meaning the government. So understand, folks, that once you start drawing Social Security and then you have to apply for Medicare Part B, you're going to see a reduction in your Social Security benefit by $135.50. That's what the number is here in 2019. It can go up from there. It's based on income, but that is the largest category that we see right now.
Yeah, good point there, Dean. Again, that can definitely be an unexpected expense if people aren't anticipating that $135.50 coming out of their Social Security benefit once they're on Medicare Part B. Another thing regarding Medicare would be if you sign up for Part A and Part B, and this is a common misconception where once you sign up for Part A and Part B, it only covers 80% of your overall healthcare expenses. So again, there's 20% that's left open, and if you don't take care of that 20%, then you're definitely going to have some unexpected expenses come up if you have to utilize it. So again, make sure you have Medicare Part A and Part B, but again, that only covers 80%. So that other 20%, you need to fill in that gap by getting either a supplement in Medicare Part D or a Medicare Advantage plan. And I've seen it before where people think they have Medicare Part A and Part B and they're covered and taken care of, but then all of a sudden they go in and they might have a surgery or whatever the case might be, and it only covers 80%. That 20%, like I said, can definitely be an unexpected expense. So that's the other thing. Make sure after A and B, you also get either a supplement and a drug plan or a Medicare Advantage plan. But again, when it comes to Medicare Part B, be aware that that $135.50 will be coming out billed by the government of your Social Security benefit to account for Medicare Part B.
Okay. The last one we're going to talk about is health insurance premiums as an unexpected expense, and this is a big one. People still are not aware how our health insurance premiums are determined in retirement through the Affordable Care Act. They are based on income. Okay, it's very important to know. We still hear each and every week, some people will say, well, I have no pre-existing condition, therefore my insurance should be cheaper. Nope, that doesn't happen anymore. That's years ago. Years ago, insurance premiums were based on pre-existing conditions and your health history. No longer. So what's happening right now is it's based purely on income. So people are looking to retire. Many times they'll say they're going to carry their COBRA insurance as long as they can before they have to get health insurance to bridge that gap between the time they retire and the time that they are eligible for Medicare. Sometimes it's the cheapest route, sometimes it's not. We tell everybody when they retire to look at all of their insurance options. Sometimes they could go into a situation where, if married, filing jointly, they're getting COBRA insurance and it could be $900 or $1,000 a month, only to find out that in retirement, because of all of their expenses being taken care of, they might withdraw less than what they would normally withdraw while they were working. Therefore, they might have a substantial savings going through the Affordable Care Act because their income is less. But please understand, when you are getting insurance premiums, it's based on income. So again, it's just planning. We'll see it every year where somebody will come in here into our office, talk to us about some of their expenses they're incurring, and we'll sit down with them and see what's going on, only to find out that they might have had insurance premiums based on, maybe $55,000 a year, and then midway through the year they took out $15,000 or $16,000 to put a screen porch on or to go on a vacation, only to find out that their premiums just shot through the roof. Yes, it's based on income. Anything else there, Tyler, when it comes to income?
Good point, Sir Dean. Regarding the income, people get subsidies if you're under a certain amount. Right now in 2019, if you're single, your income needs to be under $48,560. And if you're married, it needs to be under $65,840. And again, if you're under those thresholds, then you get subsidies that make the health insurance relatively affordable, can be, just a few $100s per month. However, if your income goes over those levels, then your potential premiums can go from a few $100s a month to a few $1,000s per month, and it can really put a damper on your financial plan heading into retirement. So again, make sure that if you are going onto the Affordable Care Act through the marketplace, that you do account for income. And one way to get around that is by having Roth accounts, and even cash positions are helpful because those don't show up as any income. So health insurance premiums can really sneak up on people if they want to retire before Medicare age. They're based on income. Make sure you keep your income under those certain thresholds if you are going to go out onto the exchange through the Affordable Care Act.
Okay, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.